Google stock is crashing. In the last 5 days alone, it's down by about 7.5%. If we look at the last month, down 8.5%. And if we look at a heat map of the S&P 500 year to date, 2025, Google is down over 18%. This is one of the largest sell-offs in all of the S&P 500 in 2025. And in this video, I'm going to show you the very simple math behind why Google is clearly undervalued at its current prices. Now, when it comes to Google, there's plenty of things we could talk about, like the AI race, like Waymo, or like Google Search's moat. And I've talked about all those things in other videos when it comes to Google. But what I want to pay really close attention to in this video are two key metrics. And that's going to be the price to earnings ratio, as well as the future projected earnings growth for Google. This alone can tell you a lot about Google stock. Let me show you what I mean. For lack of a better term, I basically just built out a sensitivity analysis valuation for Google. And I was able to build this and automatically import all my stock financials straight to my spreadsheet with the help of the ticker data add-on Google Sheets, link in description. So if we come over here, let's plug in Google stock. Again, thanks to ticker data, the data will load in. Now, the end goal for what we're doing is we want to see, based on future earnings growth and the projected PE ratio, what our total return will be in 2025, 26, 27, 28, and 2029 if we buy Google stock at its current prices, and we'll also be able to see the compounded return as well as the share price Google will be trading at in these future years. Now, that might sound complicated, but this is actually quite simple. To start off, we have to understand the PE ratio. What is the PE ratio? Well, right now we can see for Google, the trailing 12-month PE ratio is 18.85. What is this telling us? Well, if Google has a PE ratio of 18.85, it means that investors are willing to pay $18.85 for every $1 of the company's earnings. So let's jump back over to Seeking Alpha for just a moment to make sure we understand. If we look at the PE ratio, this is the forward-looking PE ratio for Google, not the trailing 12 months. But for Google, it's sitting at 18.27. Again, what this means is investors are willing to pay $18.27 for each dollar of earnings on a per share basis when it comes to Google. Now, depending on a variety of factors such as how fast earnings are growing or how wide the moat is for the company, different stocks will have different price to earnings multiples. For example, let's just look at Nvidia for just one moment. If we look at Nvidia, we can see their forward price to earnings ratio is sitting at 24.59. It's because Nvidia is growing earnings at a fast rate, and most investors believe they have a wide moat, so they get a high price to earnings multiple. Now, if we come back to Google, again, over the trailing 12 months, their PE ratio is 18.85. But here's what's interesting. If we look at the average PE ratio over the last 10 years for Google, it's about 29.06. Now, if we look at this over the past decade, we can see there's a huge outlier. So you don't have to be a data analyst to know, let's remove the outlier. Once we do that, the average PE ratio drops down to a more realistic 25.88. Now, what this means is the trailing 12 months PE ratio is 27% lower than the average PE ratio over the last decade. So what investors are saying is they're not willing to pay as much for each dollar of earnings from Google as they have been over the past decade. Let's say overnight investors did decide they were willing to pay the same average PE ratio for Google. Well, the share price would go up by 27%. But we have to remember, when we're talking about the PE ratio, there's two variables here. Yes, the price plays a factor, but the earnings also play a factor. So what does this mean? Well, it means we can project the earnings growth for the company in the future, as well as project the PE ratio in the future to see what our total return will be moving forward. So let's zoom in and take a closer look at this. Now, to start off, if we jump back over to Seeking Alpha, let's see what Seeking Alpha believes the earnings growth for Google will look like over the next few years. If we come over here and click on growth and scroll down, we can see forward-looking earnings per share, 3 to 5 year growth rate of 16.26%. That's a pretty fast earnings growth rate. Let's look at what analysts have to say. If we come over and look at earnings estimates over the next few years, we can see on the low end, we're getting about 12%, and on the high end, we're getting closer to 17%. So we have a range of about 11.75 to 16.7%. So what we're seeing is multiple analysts are telling us they're expecting double-digit earnings growth from Google over the next few years. Really, on average, close to about 15%. So if we jump back over to our analysis, let's say that we think Google over the next few years through 2029 is going to be able to grow their earnings at about 15%. Based on that information, we can see the earnings per share Google is going to generate in 25, 2026, 27, 2028, and 2029. But again, the big question is how much are investors going to be willing to pay for each dollar of earnings from Google? Because that will determine what their price to earnings ratio is. Are they going to be willing to pay what they paid on average over the last decade, or the much lower multiple we've seen in the trailing 12 months? Let's assume in this scenario, more of a worst case scenario. Let's assume investors are never willing to pay that high of a multiple for Google again, and it remains relatively low. Let's say it even declines even further. If we come over here and say investors are only willing to pay 18 times earnings for Google and hit enter, here's what we can see. In 2025, with an 18 price to earnings multiple and 15% earnings growth rate, Google's share price will jump up to $166 per share. What this means is our total return is 6.64%, and since it's year one, our compounded return would be 6.64%. But look at what happens in year two. All of a sudden, our total return is 22.6%, and the compounded return close to about 11%. And because Google continues to grow its earnings, even though it's trading at a low price to earnings multiple, by 2029, the total return would be 86.5%, with a very nice compounded return of 13.28%. Keep in mind, again, this is assuming investors are going to be willing to pay an even lower multiple for Google than they are right now. Now, let's talk about a much more bullish scenario. Let's say the projected earnings growth is going to be on the upper end of what we saw from those projections. We'll go with about 16%. And then let's also say investors think, you know what, Google search has a wider moat than we originally realized. Google's also a major player in the AI space, and their other bets segment, especially with Waymo, is starting to really pay off. So once again, we're willing to pay 25.8 times Google's earnings. What would this look like? Well, if we come over here and plug in 25.8, you're going to see pretty phenomenal results. Again, if we look at what happens by 2029, the total return would be 179%, and your compounded annual return would be 22.8%. Now, I don't like to be overly optimistic, so I don't want to assume that the PE ratio of Google is going to jump all the way up back to 25.8 over the next few years, but I do think it'll get higher than it has been in the trailing 12 months. So let's just assume it jumps back up to about 20. What we can still see is over the next few years, you could get a compounded annual return of 16.7% and more than double your investment in just a 5-year time period. And this is what I want people to understand. Google is projected to grow earnings at such a high rate that even if investors aren't willing to pay as much for Google stock as they have been over the last decade, you can still get very favorable returns over a 4 to 5 year time period. Keep in mind, if we look at the balance sheet for Google, they're sitting in a phenomenal position with virtually no debt compared to their total assets. Keep in mind that Google does now pay a dividend as well that's likely to grow at a high rate moving forward in the future. And keep in mind, top lines, bottom lines, and return on invested capital have all looked very good over the past decade. And keep in mind that last year's gross profit ratio was even higher than it has been over the past 10 years on average. So does this mean you should go buy Google stock? The answer is certainly no. Like always, it's going to depend on a lot of variables that are specific to you. But ultimately, when I think about the two sources of returns, which would be multiple expansion, meaning investors are willing to pay more for each dollar of earnings, and also earnings growth, it becomes very clear. Google looks like they're in pretty good shape. If we even go with the lowest of the low projections, just 12% earnings growth and then an even lower PE multiple, you can still see you can get a compounded annual return of above 10%. And that is why I think Google is currently undervalued. But go ahead and let me know what you think in the comments down below if you plan on buying or selling. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. I'm going to work on this spreadsheet some more and add some more features, but I'll be adding this to the ticker data library as well soon. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.